Well, hi, I know I'm a little late on this video, but I thought that it would be a good opportunity for me to do this now. This has been a very busy trading week, and but I'm pretty excited about this video. And the reason is because candle patterns or price action, the things you actually see on your chart, are the most important things in most trading systems. In my trading, I use candle patterns predominantly to time the entry into the market, whether I'm buying or selling. Doesn't matter what I'm buying or selling. It could be any of the major currency pairs, which I normally trade: the pound, the euro against the dollar, the Swiss franc, Japanese yen, Australian dollar. Or it could be commodities, it could be stocks, it could be gold, dare I say it, even Bitcoin, which I don't generally trade very much myself. But the candle patterns are the essence of market timing, how to get into the market with the best probability of success. So in this video, I'm going to go through these basic questions, and I'm going to point you to a couple of other slides that I've already prepared for this, and let's get right into it. So candle patterns. I'm going to assume at this point that you at least have some semblance of knowledge about what candle patterns are, about trading in general, about how to use charts, how to use a broker, that you know the basics of trading regarding the pairs that you want to trade, the time frames, the currency, you know, all that sort of thing, and that you have some idea of what trading is all about. If you don't, this might be a little bit too difficult for you, but you can always come back to this once you've got some experience and recap these essential bits of knowledge about trading. And I've been trading for about 20 years, and I still use predominantly candle patterns to time my entry. And I use that phrase, time my entry, very carefully, because candle patterns are there for just that, to time the entry into the market. And there are other things that we use to determine the position of entry or the areas in which we want to be trading. But the candle patterns are the chart patterns that you see, the price action that you see on the chart, which help you to time those entries and have a much better probability of success than if you don't understand these. So first of all, this is what we're going to cover in this video. Candle patterns, what do they look like? I'm going to go through about 10 different candle patterns that I use predominantly myself, and I'm going to discuss the probability and the risk involved with each type of pattern, and try and explain to you which ones I prefer over the others and the reasons why. Then I'm going to go into a little bit of information about when to use these patterns. So once we've identified which patterns we want to be using, and we've spotted them on the chart, it's very important to note that we need to only use these candle patterns in areas on the chart, in other words, levels on the chart, or the price levels, where these candle patterns make sense. So we'll be looking at what time frame chart to be looking at, and a lot of this depends on whether you're a scalper, a long-term trader, a swing trader, intraday trader, or multi-day trader, even multi-week trader. We'll talk about whether we want to be using 5-minute charts, 15-minute charts, 1-hour charts, all the way up to 1-week charts. And then we'll talk about what chart levels we want to be looking at on those time frames, and where we want to be trying to identify these chart patterns. And we'll come back to all of that in a little while. But first of all, I'm going to go into the chart patterns, the candle patterns themselves, and have a look at each one of the main ones. There are loads and loads of them, but I'm going to look at the most important ones, and try and explain to you why some are better than others in order to get into the market, identify trade opportunities. So that's what we're going to have a look at now. So I'll just pause this very quickly and go across to the next slide. So here we are on some little graphics that I put up, and I'm going to go through a number of chart patterns or candle patterns on this section of the video. And I'm just going to go through them, and then I'm going to go across to a different slide and rank them for you and show you which ones I think are better than the other ones and the reasons why. So the first one is a dark cloud cover. Now, you need to know a little bit about candles in order to understand what actually creates this pattern here. But essentially, we have a bullish candle, this white one over here, which goes up to, starts there at the bottom of the wick. That's the low price of this hour. Now, this could be an hour, or it could be a week, a day, 5-minute chart, doesn't really matter. They're all applicable to whichever time frame you're looking at. So this one here, we have a low formed by the lower part of this wick and a high formed by the top part of this body of the candle, and that's the range of the candle from the low to the high. And the very next candle goes up a little bit, forms a little spike high there, and then moves down and closes more than halfway down this bullish candle. So we've got a bearish candle with a high and a low at the bottom here, which follows this bullish candle pattern with a high over there and a low over there. And you can see that even though we made a new high on this next candle, we actually closed the candle more than halfway down through the body of the previous candle. This one is called a dark cloud cover. It takes place at the top of a move, and it's a bearish reversal candle pattern called a dark cloud cover. And I've made a little note on each one of these slides to give you an idea of what we'll cover next, and that's the probability versus the risk. The problem with a dark cloud cover, or should I say the attributes of a dark cloud cover, are they have a high probability of success. So whenever you see this sort of pattern, you know that the chances of this being a genuine and a proper reversal are really good. However, because this dark cloud cover candle pattern is often a fairly large pattern on the chart, in other words, we've had quite a long way up here to the top, quite a long move, followed by a large drop-off, the length of this candle, the body of this candle plus the wick, is quite large, which means that if we enter the market after this pattern is formed, in other words, to sell, to go short, we're going to need quite a large stop loss, because our stop loss needs to be above the wick, the top of the wick of this pattern over here. So in my experience, generally, your stop loss would have to be between, maybe 20, but generally somewhere around 30 to 50 pips on this sort of pattern, simply because of the length of this formation here. From the above the top of this wick to the close of this candle would generally be in the 30 to 50 pip range. So even though it's a high probability candle pattern, high probability of reversal that it's actually going to happen, it requires a bigger stop loss. And so the risk is low in terms of probability, but it's higher in terms of the size of the stop loss. That's very important to bear in mind. And the reason why we need a bigger stop loss, simply because we've got a big candle pattern here. And our stop loss always needs to be on the other side, in this case above the wick of the reversal candle that we're looking at. So that's a dark cloud cover. Then we have a piercing pattern, which is essentially exactly the same thing, but from the bottom of a move down. And here we've got a bearish candle. This is not exactly the same as the previous one, but it's similar. Here we have a bearish candle, a move down all the way down to the bottom of this wick here, then a slight bounce back up again. And then the next candle, the one that we'll be looking at for this pattern, and these are both of these are two candle pattern formations. The next candle forms a similar low and then closes in a bullish pattern above halfway through this bearish preceding candle. So that's called a piercing pattern. It's called piercing because it happens at the bottom of a move down. It's a reversal, meaning we want to trade upwards. And really what we're doing is we're piercing the low. And this candle this wick here on this on the next candle, this wick could actually be even lower than the preceding candle. That doesn't make any difference. What we're looking at is the bodies of the candles in these patterns, and this candle body has closed more than halfway up through the preceding bearish candle. And very similar to the dark cloud cover, we have a high probability of success on this trade. It's a very high probability reversal pattern, but once again, we have a bigger stop loss. So the risk in terms of number of pips we'll be risking is high, but the probability of this being a successful trade is also high. And those two will play off against each other. And I'll try and do some basic sums, playing off the risks involved in terms of probability and the stop loss size. But in the same way as the preceding pattern that we looked at, this dark cloud cover, our stop loss needs to be below the wick of this reversal candle, and our entry point will be on the close of this candle, which in this case is at the top of the body. We don't really want to see any wicks on these two patterns. So we don't want to see an upper wick here. We just want to see a nice clean, what you call shaven head. We'll talk about shaven head candles in one of the other slides a little bit further down. But we want to see a clean top. And the same in this case, we want to see a clean bottom. We don't want any wicks. Or if we do have a wick, we want it to be a very small wick. So that's a piercing pattern. It's a bullish pattern. It's a reversal pattern. It takes place at the bottom of a move. There's a high probability of success, but also has a high stop loss. And that also would be typically in the range of between, I say 20, but generally more like 32, if you include the fact that we need to be below this candle for our stop loss, below the wick of this candle. If you add on another 5 or 7 pips below here, that would generally be about 30 to 50 pips in terms of the stop loss that you would put on there. Now, we can mitigate these high stop losses in terms of pips, obviously, by reducing our position size. And that's generally what we would do, is trade a smaller position with a larger stop loss so that our overall risk on the trade is much lower. So those three things play off: the risk of the bigger stop loss, the position size, and the probability of winning the trade. I hope that all makes sense. Engulfing pattern, very similar. In fact, this is a bullish engulfing pattern. The same applies on the downside as like the dark cloud cover and the piercing pattern. You can get the same formation at the top or the bottom of a trend, and this engulfing pattern is similar, except that it's even better, because the candle, the reversal candle, this is a bullish engulfing candle pattern, takes place at the bottom of a move. This candle has engulfed entirely the body of the preceding candle. So similar to this one, this is a piercing pattern. We've got more than halfway up and closed with a nice clean head. In this case, we've got more than halfway up, plus we've got above the preceding top of the bearish candle that was before this one, and we've got a bullish engulfing candle pattern. Now, as you can imagine, this one will have an even higher stop loss than the piercing or the dark cloud cover candle patterns, but the probability is also higher. So the more engulfing this candle becomes, so in this case it's completely engulfing and it's closed way above the top of the preceding candle, and it's a clean shaven head candle. That's a higher probability than this case, which is also a good probability, but this one is even better. But because of the length of this candle body and the length of the overall pattern, the stop loss would have to be even bigger. So we get an increase in probability compared to the dark cloud cover and the piercing patterns, but we also get an even bigger stop loss. Okay, so bear that in mind. We'll come into more detail a little bit later on. Doji Star. Now, this is an interesting one. You can see the open and the close are at the same price. That's this horizontal line, which normally would be a candle body, but because the candle closed at the same price that it opened, we don't have a body really, we just got a line. Sometimes that can be a slight, tiny body, but the closer it is to just being an open and closed price being the same, the better. And we've got very small wicks on either side. So basically what this happened with this candle, when this hour opened, or this 5 minute or day, whatever it happens to be, whichever time frame you're trading on. The price opened there, moved up a little bit, down a little bit, and then closed at the same price. Or it could have moved down first and up a bit and then closed at the same price. It makes no difference. That's called a doji star. That's a reversal candle. It's a single candle pattern. It has a very much lower probability of being a reversal candle than the engulfing or the piercing type patterns, but also has a very tiny stop loss, as you can see, because we've got no body to this candle and the upper and the lower wicks are very small. And so we could get into this trade at the close of this candle, and this applies to the top or the bottom of a trend, so it could be bullish or a bearish candle. It doesn't matter where it occurs, at the top or the bottom, it's the same thing. But whichever way we're going on this candle, the stop loss would be very, very small. So if we got in here long, for example, stop loss would be just below there. If we got in here short, the stop loss would be just above there. And so in terms of stop loss sizes, sometimes you can get away with as little as 10 pips. But generally somewhere between 10 and 20 pips, 10, 15, 20 pips. So we have a lower probability of success on the trade, but we also have a much smaller risk. So sometimes these are worth having a go at if you're prepared to risk just 10 or 15 pips. Or you could say, well, okay, it's not a brilliant probability trade, but there is it's better than even, let me put it that way. And our stop loss is really small in terms of pips, so we could actually increase the position size a little bit more in order to take advantage of the possibility of this moving in our direction and making a bigger profit for a similar risk level in terms of dollars rather than pips. Right, and then we get these. These are reversal patterns again. These are single candle patterns, shaven head, hammer, or gravestone doji candle. And these can be at the top or the bottom of a trend. These are generally at the top of a trend, where it's called a hammer because it looks like a hammer. This is not a gravestone. Gravestone happens at the bottom. But if you flip these on their heads, in other words, put the wick at the top instead of the bottom, as they are shown here, then you get the gravestone type pattern. And here, in this case, if it's at the top of the trend, that would be a gravestone would be at the bottom. At the top of the trend, we would refer to this as a hammer. All right, are these good reversal patterns? Yes, they're pretty good. Better than the doji star, this one that we had a look at. Better than that. And we still also have a relatively small stop loss. So these are good opportunities to have a punt. And that's the word I would use. It's a bit like betting, really, because we're looking for opportunities with good probabilities for low risk. It's a bit like betting on a losing team in a soccer match, for example, or a team that's expected to lose. So I could put $1 on Arsenal beating Barcelona, as they didn't do yesterday, and the odds might be 20-1 in my favor. So it's worth risking $1 to win 20. So that's the sort of way we would look at this in terms of probabilities and risk. Probability of these trades, not brilliant, but quite good. Not the best by any means, but not bad. But you can get in with a smaller stop loss. Why? Well, because if we're selling, remember this pattern, either of these candles take place at the top of the trend, we'd be selling, and we could get away with literally 10 pips stop loss, sometimes even 7 or something like that, or 5, depending on the spread that your broker offers you, because we'd be looking to go short. So you'd be getting in, if it goes in your favor, right at the top. In this candle, we'd be getting there at the close of the candle, right at the top. And in this opportunity here, we'd be getting in right at the top again, with almost nothing in terms of a stop loss in pip terms. And depending on how you load that trade up in terms of dollars or leverage, you could have a very good risk-reward ratio on that sort of trade. Bear that in mind as we come to the next set of slides. One up, one down. This is one of my favorites. And you can see there, I've put in a medium probability and a medium stop loss. So this is sort of, when I say medium probability, it's better than a low probability, but it's pretty good. It's one of my favorite patterns. Perhaps I should even have put in there medium to high probability of success and a medium stop loss, because we don't have very big candle patterns here. The distance between the highs and the lows on both of these is relatively small, not the smallest, not like a star or a hammer or a gravestone, but still quite small. And you'll be able to get in with a medium to, I'm going to say medium to high probability and a medium stop loss. So overall, pretty good. Remember, this is a 2-candle pattern. This can take place at the bottom of a trend. In other words, we'd be looking to trade up, or it could take place at the top of the trend. We're looking to trade down, and they look very, very similar. Whether you're at the top or the bottom makes very little difference. So that's what I call one up, one down. I don't know if there's actually a term in the books for this, but this is something those of you who have followed me for many years will know that this is one that I always pounce upon, simply because I think it's a fair probability of success, medium to high. Perhaps I should have changed that. Might be a little typo. Medium to high. Put that in your minds. So just put a little stroke there and put high, medium high, and a medium stop loss. Always a good one to have a look at, particularly on the longer term charts like hourly or daily charts. So highlight that one for yourself. Spike highs and lows. Well, yeah, these often, I think this is a real medium type probability. It's not the best by any means, but it's not the worst. If you see a spike high like this, doesn't matter if the body's bullish or bearish. These are spike highs that take place at the top of a trend, and you'll be looking to sell at the close of any of these candles, either of these, with a stop loss above the highs or the top of these wicks. At the bottom of a trend, if we're looking to buy, these would just be upside down. Don't know if no, I haven't got those there, but they would then be spike lows. So these are spike highs, a spike low. It's exactly the same thing, but upside down. In other words, the long wick is at the bottom, not at the top, like it is in this case. Medium probability of success. You often get sort of fake spikes that don't work out, but sometimes they work out beautifully. And again, particularly on longer term charts, these are better, especially on daily charts. So that's something to bear in mind. So I'd say medium probability, but you also have a bigger stop loss. That's the problem. Because these spikes are often quite large, again, you'd be looking at 30 to 50 pips in terms of a stop loss if you wanted to put your stop loss above these spikes, above the top wicks in this case, or if they were upside down below the bottom wicks. So medium probability, but a bigger stop loss. The 3-step, there are different names for this. It's a fairly simple pattern, really. What you're looking for, this is a bullish pattern. The same applies to a bearish pattern, but then they'd be all upside down going the other way. But this is a bullish pattern. You'd be looking for this at the bottom of a trend to reverse to go up. And you get a bullish candle with a small wick on the top. We don't want big wicks here. We want a big bullish body with small wicks. Doesn't matter if that lower wick's quite long. Could be a spike and a nice bullish candle. That would be even better. Bear in mind that means your stop loss would have to be bigger though. So we get a bullish candle showing some bullish intent. The next candle we get is a retracement, a pullback, which would scare a lot of the bulls into thinking this might reverse. But if this doesn't get more than halfway down, and halfway is about the maximum that you want to go to on this sort of pattern. So if this next candle closes, this is actually a 2-candle pattern, but I've extrapolated it into the 3rd candle just to show you what would happen. So you get the bullish candle, clearly a bullish pattern, small wick at the top, that's what we want. We get a retracement and a close above halfway down through this previous bullish candle, and that's when we buy, right there. Going into the next candle, we might get a small retracement and then a move up. And that completes the three-step pattern. There are other people that have different names for it. I can't remember what they all are now. Some people call it a 1, 2, 3 or a 1, 2 go or something like that. But basically what we're looking for is a bullish pattern, a pullback to get into the trade, close of this hour or 5-minute or day chart, whatever chart you're looking at, and that's where we get into the market for the next move up. And the next candle, this third candle, should be roughly the size of the first candle. So that if you're setting targets, that's kind of what you're looking. So if that candle was, if it was an hourly candle of 30 or 50 pips, pullback of, let's say, 20 pips or so, get into that, and we want to get 30 to 50 pips out of the next candle in order to set an exit target. So in terms of probability, medium probability, yeah, not much better than medium, but still better than even odds, I would say. It's always a little scary when the next candle starts to pull back like this, but if it doesn't pull back too far, we don't get below halfway of this candle, and we close in that fashion without too many spikes and wicks and things, then the next one we can get into. We have a smaller stop loss because the moment we get into this trade here, this is where we get into the trade, remember, as this candle closes, we can put the stop loss quite tight underneath here, because if it goes lower than halfway, well, there's a good chance that that trade will fail and we may have lost the trade. The pattern may have failed at that point. So we can put our stop loss very close beneath the entry point on this candle. So small stop loss, but not much better than a medium probability of the trade. Remember, all of these candle patterns that I'm talking to you about right now, I'm using them here because I think that they're all good candle patterns. It's just that some are better than others. But these are the sorts of patterns that you'll be looking for to enter trades. Tweezer, this is a good one, always a good one. It's called a tweezer because it looks like a tweezer. It's another two candle pattern. We got two spike highs, roughly the same length. Doesn't matter too much whether these bodies are bullish or bearish. This is the ideal situation where the second candle is a bearish candle. In other words, the body of the candle closes lower than it opens. And but the important point of this part of this is that we've got this tweezer pattern, two spike highs following each other, or one following the other rather. Again, I'd say a medium probability. Sometimes you get 3 or 4 of these in a row. The more the better, actually. So having 2 like this, the tweezer pattern, is better than just having 1 spike high, and having 3 is better than having 2. So the more that happen like that, the better. It shows that the market is really struggling to break up through various resistance levels, and every time we do try, we fail and fall back down again, which shows that there's a lot of selling pressure above us at these levels. So medium probability, again, I would say probably medium high, but again, because of these big spikes, you have a bigger stop loss, so that reduces the attractiveness of the trade somewhat because of the bigger stop loss. But if that is the case, if you need a bigger stop loss, you can always reduce your position size to keep your dollar or your percentage risk within reasonable levels. Shaven head, I actually quite like this one. And this is a little scary for a lot of people, but it's very attractive because often when you get a shaven head, the market just suddenly abruptly stops at this point here. So this is a bullish shaven head. You can get it going the other way down, of course. In other words, if you turn this upside down and color this in black, you'd get a shaven, I suppose, bottom, you'd call it. Same sort of thing. But you can see the market has reached that level and abruptly stopped. Now, you'll see that actually so it's the 29th of May right now, Sunday, you'll see that if you're going to have a look at the S&P or the NASDAQ chart, and I'm looking to sell S&P and NASDAQ into this coming week, and we've got a shaven head on both of those charts. Very, very similar to what this looks like. In fact, I could switch across there very quickly if I can get in there. No, I can't. Oh, there we go. Okay, so there we've got a shaven head on the NASDAQ. Let's just have a quick look. Right, so that's the candle I'm talking about right there. There's a shaven head on the NASDAQ. Have a look at that candle. This is real time. This is Sunday night. Market will open in a few hours' time. And that candle pattern there is exactly the same as this one here that I've got on my little sketch. And I wouldn't be surprised if the NASDAQ moves down from where it is at the moment. That's just an aside. Medium probability. Yes. Why? Because it's a bullish candle. It's scary. It may very well push higher, probably after a small retracement, the next candle, but it may push higher. But you can get in with a very tiny stop loss, and there I've put in tiny, not just smaller or small. In this case, I've put in tiny because we can literally get into this trade with the expectation that it'll immediately start to move down. If it doesn't immediately start to move down and starts to move up instead, we know that we're probably wrong on the trade. And we can get out super fast for very small risk in terms of pips. If this was an hourly chart, again, somewhere around 10 pips or less, slightly less even. If it's a 5-minute chart, you could probably get away with just a few pips, maybe 5. So shaven head, medium probability. I like to trade these because I can take a trade here and I think to myself, well, there's a 50-50 chance of it winning. And if it loses, it doesn't matter. I'm risking 10 pips. If it wins, I could be in for 50 pips. So I've got something like a 10-to-1 risk-reward ratio on these sorts of trades. I like it very much. And that's it, really. So just to recap, let's go to the top. Dark cloud cover. So bullish candle followed by a bearish candle, closing more than halfway down. High probability. Very good pattern. I love it. But a bigger stop loss. So you're going to have to think about your position size in that case. Piercing pattern, exactly the same thing, but from the bottom up. High probability, but a bigger stop loss. Same sort of thing. These are two of my favorites. This is probably my ultimate favorite in terms of chances of winning the trade. Engulfing pattern. If you go back through your charts, have a look through, scroll through them, have a look at examples. This has an incredibly high chance of winning, but you're going to have to use a bigger stop loss, which means a smaller position size, and or trading less instruments in the same direction. However you choose to manage risk, you're going to have to manage risk, but the opportunity to win these sorts of trades is very good. Doji star, as I said, small probability or lower probability, but a very small stop loss. That's when you see it looks like a star at the top or the bottom of a trend. It's a reversal pattern. I would say it's 50-50 really, but you can get in with a small stop loss, so that makes it attractive. Shaven head, hammer, or gravestone, depending on which way up it is. Probability slightly lower than the others, I would say, but again, a very small stop loss, because if it moves up above your entry point, you know you're wrong straight away, and you can get out for a very small loss in terms of pips. One up, one down. Another one of my favorites. Medium to high probability, as I said, and combined with a medium stop loss makes this very attractive. Again, this can happen at the top or the bottom of a trend, and actually it doesn't make any difference either which way these wicks are on either the top or the bottom of the trend. This one could be up, that one could be down, doesn't matter, as long as you get this one up, one down pattern, or one down, one up, whichever way it happens to form. Spike highs and lows, medium probability. but a bigger stop loss. And as I said, the more of these that occur in a row, 2 is better than 1. This is a 2 candle pattern. 3 is better than 2, and so on, because of the fact that we know that there's selling pressure in this case, preventing these candles from actually following through with those surges higher. The 3-step doesn't happen all that often, but when it does, it's worth a go again. You can get a small stop loss in, wait for a nice bullish candle, wait for it to pull back and close with a small wick or no wick, preferably. So we got a shaven bottom following this bullish candle, and then aim for a move in the 3rd candle equal to the size of the 1st candle. Tweezers, yeah, not my favorite, but they're not bad. Medium probability, not much better than medium probability. Again, the more that occur in a row, the better, but you have to have a bigger stop loss, so therefore you've got to manage your risk. Shaven head I like very much. Medium probability, so it's not the highest probability, but it's still pretty good, but very tiny stop loss. So the moment that this candle closes, you can get in for a short in this example, hoping to move down, and you can have a very small stop loss of just 10 pips or so. So that's that. Those are the candle patterns. What I suggest is that you make a sketch yourself in a book or on your computer, write these down, and make a note of them and start to look for them on your charts. Now what we're going to do is have a look at how to rank these. So we'll go there next. So a very simple way of ranking these is, as I alluded to before, we can compare the probability of winning and the risk of entering the trade in terms of the number of pips you need to risk, and then give them an overall ranking. Pretty simple, really. And I've had to suck some of these numbers because they're, depend on all sorts of things, but I've tried to give them something reasonably sane and thought out. And let's go through some of these. So, and you can see I've ranked them from 1 to 5 based on these numbers here. So let's have a start with DCC, which is a dark cloud cover, or piercing pattern. Those are the two. You're going to have to go back and have a look at the beginning of this video to remember what they are, unless you've written them down somewhere. Dark cloud cover, I've given it a ranking of 1. The probability of winning, and the reason is the probability of winning, I've given a ranking of 8. The risk, I've given a probability of 6. When I say probability, I mean 10 means great, 1 means bad in these two columns. So in terms of the probability of winning, it's good, very good, 8 out of 10. In terms of risk, it's only 6 out of 10 because, remember, these need bigger stop losses, dark cloud covers and piercing patterns. So risk is higher, therefore we get a lower ranking here. And if you add those two up, you get a 14. Same with the piercing pattern. Those two are the same, just on different sides of a trend. Engulfing candles. Remember we talked about bullish and bearish engulfing candles. I've given the probability of a win on these trades as very high, 9 out of 10, but the risk is 5 because these are often the biggest sorts of patterns in terms of the amount of pips that they stretch over. And so in terms of risk, pips risk, it's not that good. But if you add the two together, 9 plus 5, you get a 14 again. So very good in terms of the overall ranking. And the shaven head, the probability is quite low, but the risk is really good. So we get an 8 ranking on the risk, but only a 6 on probability. But if you add the two together, you get a 14. So those are it's as simple as that. So I've ranked them according to these overall numbers. And dark cloud cover, piercing patterns, engulfing patterns, shaven heads, those are all ranked number 1. Those are my top 4 candle patterns, and they all have the highest overall ranking. Then we're followed by the hammer and gravestone doji candles. Those are ranked at 2. Probability, not very good. but the risk is good. I've given 8 out of 10 for risk. Remember, you can get in with a very tiny stop loss on these. Same with a star, very tiny stop loss, but I've given that a very low probability, the star, of only 4. But again, if you combine, add those up, 5 plus 8 is 13. So that gives you a 13, that's a number 2 rank on my overall rankings. And a star, Doji star, I've given an overall rank of 12. So that's slightly worse. Then we get down to the one up, one down. That's ranked at number 4. Probability, 6. Okay, better than 5, but not the best. But the risk is 5 because you're going to need a big stop loss on there. And overall ranking is 11. Tweezer, same sort of thing. We've got a probability of 6, a risk of 5, and an overall ranking of 11, which makes it 4. Then we get to these. These are actually, funnily enough, the most common and interesting ones for a lot of traders, but they're my lowest ranked. They're lowest ranked because I think the probability of winning is pretty low. You've got a 5 on the Dragonfly, 5 on the Spike high and low, and a 4 on the 3-step. And then the risk on these trades is not great either, so we get 10s for those 3. And there might be something in that, these are the patterns, the ones that I've ranked the worst are actually the patterns that people seem to rank the highest. And that might be very well why they fail most often. Because everyone's looking at these thinking this is money, money, money. But when everyone's doing the same thing, that's when you tend to run into trouble and they don't work. So that's it. Really as simple as that. No, this is a bit of a weird video because I'm busy recording this in the dark, so you can't even see my face. It's dark and gloomy, and we've got load shedding going on here in South Africa again, which means all the lights go out, but at least my computer works. So top candle pattern rankings: dark cloud cover, piercing pattern, engulfing pattern, and a shaven head. Those are the ones, if you want to discard all the others, those are the ones you should be paying attention to the most, followed by the sort of middle of the range ones, the hammer, gravestone dojis, the stars, one up, one down, tweezers, somewhere in the middle. Not bad, but not the best. And then the ones that I rank the worst are the Dragonfly Doji, the Spike High and Low, and the 3-step. And they're significantly lower than the top 3. So that's it. So if you're trading and you're looking for candle patterns on your charts and you want to enter into high probability trades and low risk trades, these are the ones that you should be looking for. Right, so let's go back to our first slide and quickly recap. I don't have a lot of time to faff around, but in terms of making this into a beautiful and fancy video production, but what I've tried to do here is to point out to you what is important in terms of candle patterns and what they look like, which are the best ones, in my opinion. And I'm going to quickly go through this again. And you can pick out from here, I think this is a really important video, pick out from here what you will find useful in your own trading and get to it and help yourself to your trading with some good high probability trades. So we've had a look at what the candle patterns look like. As I said, make a note of them, write them down, draw sketches, go and Google some of them. There's a lot of information. You'll find there are a lot more on the interwebs, but I've pointed out the ones that I think are the most important. Which offer the best opportunities? Well, we talked about probability and risk in terms of the probability of it being a winning trade opportunity with that particular type of pattern and the risk associated with those in terms of pips, and how you combine those two together to come up with a good ranking for those patterns. When to use them, we're going to come to this shortly. What time frames? Okay, this is really important. Depending on how you trade, I generally trade in the 1 hour to 1 day range. I'm not a scalp trader generally. I do a bit of 15-minute trading, In fact, my London Forex trading system is based on 15-minute charts. But generally, I trade in this range here, 1 hour to 1 day charts, which means my trades generally last at least a day, sometimes several days, even up to a week sometimes. But you can use those patterns on any time frame. This is what I'm trying to emphasize here. Whether you're a 5-minute scalping trader, in fact, I've seen people using exactly the same chart patterns on 1-minute charts, particularly people that trade stocks and commodities of very short-term charts. They often use some of these candle patterns themselves. But it doesn't matter which time frame you're trading on. All I can say is that the longer-term chart that you look at, the higher probability you can associate with those candle patterns. So if you say a particular type of candle pattern on a 5-minute chart, there's less chance of it working out than if you look at an hour chart, and there again, less chance than if you're looking at a day chart. So that's the sort of thing you've got to bear in mind. The longer the time frame that you look at, the higher the probability you can assign to these chart patterns. And that even goes all the way up to a week, and sometimes even a month. What chart levels? Now, first of all, we're looking at these chart patterns as entry opportunities to get into the market. We're looking for a signal, a trigger to press the button and say buy or sell. But we only want to do that. We only want to do it when we're at a level on the chart where it makes sense to take the trade. And I'm not going to cover this in this video. And I have covered this in some of the other videos I've made. I've put up on YouTube and also my training courses. But the chart levels that we want to look at are really important. And I've sort of ranked them in terms of importance here. But first of all, SR lines, which means support and resistance lines. Look for simple horizontal lines on your charts where there's been previous support or previous resistance. And draw those on your hourly charts. Draw them on your daily charts, on your weekly charts, and even on your 15-minute charts. And then put them into, so for example, if you're trading a 15-minute chart, switch to your hourly, draw those lines in on your hourly chart. Switch to the daily, draw same lines in on the daily charts and even the weekly charts if you want to go that far. And then switch back to your 15-minute charts with those lines still in place, taken from the longer term charts. Generally, I would trade on hourly charts mostly, but then I'd look at weekly and daily chart levels, horizontal lines of support and resistance, draw those in, or not literally draw them on my screen with a pen, but put them on the charts with the software that you're using, and then switch back to your chart, in my case, hourly chart, and those lines will still be there, and you can see the important levels on your chart from which you want to be trading. And they will give you often very good reversal levels. These are the most important. You can add to that, actually, if you want to, you could add Fibonacci lines. So let me just type that in right now. Fibs, there we go. So these are also really important. The ones that I like are 38.2, 50%, 61.8%, and 78.6%. So it's 38.2, 50, 61.8, and 78.6. Those are the most important Fibonacci lines that I like to look at. Let's make that green just to highlight that. Very important, and often, and particularly if these fib lines, okay, let me just put that in there so it's here. So it's 38.2, 50, 61.8, and 78.6. There you go. I've done it for you. So draw those on your charts as well. If those lines there, if those fibs coincide with any of these lines, that's a super high probability area of reversal on your charts. I need to emphasize that. This is actually the key to successful trading. If all you've got are your candle patterns and this line here, which I've highlighted in this document, if that's all you've got in your charts, these lines, and you observe your candle patterns, you can be a very successful trader. That's all you need to know. And I say that with a pinch of salt because, of course, you need to know a lot of other things as well in terms of risk and reward and trading, mechanics of trading, trading psychology. There are loads and loads of things that you need to learn in trading, and it's not quick and it's not easy, but it can be done. But let's assume that's all in place. This is the most important thing, combined with the reversal patterns, candle patterns that I've described in the previous part of this video. Then you can look at trend lines. Yeah, trend lines are pretty good, useful, particularly the longer term trend lines. So again, look at the hourly, daily, and weekly trend lines. If weekly, not so much, but hourly and daily, really important. And then moving averages, if you like moving averages. I'm not a great fan of them. They tend to work better in stocks and commodities than in currencies. But if you want to put moving averages on, those are the ones that you could put on: 20-period moving average, 50-period moving average, 200-period moving average. Don't worry about exponential moving averages and weighted moving averages and all of that sort of thing too much. If you're trading stocks, you might want to look at the volume weighted moving average, or VWAP, volume weighted average price. That's a good one. The 20-period VWAP on stocks is pretty good, but not so much on currencies. Well, you can't get volume on currencies anyway, so obviously that's useful, not useful. But if you want to be using moving averages, just use simple 20, 50, and 200-period moving averages on the hourly and the daily chart. But once again, I must just highlight this line here, and I could make that bold. There we go, bold, very important. Put those on your chart. Have a look at the candle patterns over here. Watch out for those on the hour, on the 5-minute, on the 15-minute, on the daily. Combine it with these, and that's a really, really good start to technical analysis, and I think you'll find that useful. Okay, so a little bit of a choppy video, but I think it's a really important video, and if you can pick out the good bits from my waffle and apply it to your trading, it should be incredibly useful to you. Take care.